Right, okay, we've hit 10 o'clock now. So, yeah, good morning to everyone that's joining the call. Hope you're all keeping well. Today, we're presenting the webcast on the topic of managing liquidity in a negative rate environment, with a particular focus on money market funds. I'm joined today by Gavin Hayward from Federated Investors, Director at Federated. How are you doing this morning?
I'm very good, thanks, Greg. Thank you very much for having me. Hope everyone's keeping well.
Yes, good. I'm sure I understand your children are back at school now, so are you enjoying the peace and quiet?
I'm enjoying the peace and quiet. Yes, luckily not one of them to come charging in and bothering me. I can't say the same about the dog, maybe, but yeah, I think we're. It's an interesting environment. Everyone's getting quite used to it, I think, at the moment. But yeah, certainly no complaints from my end. I'm certainly looking forward to the saving I'm getting from not having to commute into London every day.
Indeed. It sounds like that may be continuing for some time to come. So we'll move into our topic for today, looking particularly around the spectre of negative interest rates and their impact on liquidity and money market funds particularly. Now, it's something that keeps being brought up, even though in sterling markets, the Bank of England seem to have poured cold water on the idea of negative interest rates, certainly in the short term at least. But yields have been moving ever further towards zero. Perhaps before we start to talk about the experience and what might happen in the sterling markets, which is of most interest to our UK-based local authority investors, this isn't a completely unknown thing to the money market fund world, because yields have been negative in the Eurozone and in Euro money market funds since 2013 or 14. Perhaps you could just make some comments around the experience of the Euro sector in the money market fund world and what you saw there and the perhaps different changes that were needed and how clients reacted.
Yeah, I think it's a very valid point. I think in Europe it's a slightly different situation in that in the UK, obviously, the Bank of England is able to set rates independently, but obviously in Europe, there's a political direction that comes to the European Central Bank in determining rates. And obviously, with a wide group of Eurozone members, all of whom have significantly differing economies and pressures on their economy, the drive to make a unilateral change, it's something that they thought was necessary as a sort of super stimulative effect. I think history will show that not to be particularly effective, I don't think. And I think the sort of drive to do the same in the UK will be caused by something very, very different. And I don't think it's going to be caused by COVID.
Oh, that's interesting to note. I mean, do you think if we are going down the route of negative rates, do you think there are any particular or unique challenges in sterling markets and sterling money market funds compared to what we've seen in the Eurozone, or will no matter the cause of it, will what actually happens be relatively similar? Do you think?
Well, I think if you look at the UK market as a whole, London is seen as being, the most robust of the, financial sectors around Europe, and the ability for entities to use the London market in order to maintain their, to enable them to maintain their financing has always been seen to be very, very important. Now, the whole point of having a very low interest rate, or indeed a negative interest rate, is to create that stimulatory effect. But I don't think that there is going to be the drive or the need to do that in Europe, in the UK, because, of course, the very high nature and the very high quality of the financing that gets undertaken in London is something that's always going to attract, one would hope, a little bit of a premium. And with the Bank of England being left to set rates on its own, they're going to take a very, very close look at all of the potential scenarios around negative rates before they ever consider introducing them in the UK. And notwithstanding the fact that interest rates are very low at the moment, obviously with a with a rate of 0.1 at the moment. There's not an awful lot lower they can go at the moment, but they certainly do have a couple more bullets, notwithstanding the fact, remember, that in the UK, as opposed to the States, for instance, we still haven't seen the level of liquidity support put in place by the Bank of England, simply because I don't think they think it's needed, whereby it obviously was needed in the States. So I think we are quite a way away from it. As to the challenge of actually, meeting the challenge of a negative rate, again, one has to look at what the alternatives are. Of course, if the market does go negative, if the published Bank of England rate does go negative, this is something that we will all just have to get used to. It'll put in place changes that none of us have seen before, but we will just have to put in place the relevant changes that we will need to do to address those. And all money market fund managers, not just ourselves, are well underway with regard to that process, just in case it happens.
Yeah, so it certainly sounds like you have a fairly similar view to Arlene Close's base case around the Bank of England base rate. We're not expecting that as a central case to go negative, but there still does remain the chance of that. Now, it's the case that although bank rate isn't negative at the moment, parts of the market are, and certainly
yes,
gilt yields are negative out to around 5 years, I believe still. So do you think even if policy rates, if bank rate in the UK stays positive, if there's an expectation that rates could be cut further down the line, which is presumably what these negative yields are suggesting further out to 5 years, do you think money market funds yields themselves could still go negative because of that, even if the bank rate is still positive?
That's a very interesting question. It's going to depend to some extent on the manager, and I can't talk for our peers, but certainly Federated has a lot of experience in this market and weathered a situation in the States for a long time with a published rate in their funds of 0. But as you quite rightly said, there are a lot of credits in the marketplace that we buy within the fund that are flat out. In many cases, supranationals, they're entirely flat out till 9 months. Some of them much longer than that, as you said. You even mentioned 5 years, and we're not seeing any real value in the marketplace right out until about a year or so. Some of the New Zealand and Canadian and Australian names, for instance, we're picking up maybe 2 basis points in the 1 year on those names, and it'll depend to some extent on what managers do with regard to their credit list. I'll get straight off the fence and say that we are not going to change our view on credit to try and chase a few basis points of yield. I think we saw problems developing around some of the Qatari names that we saw a few years ago, where those names had to get ditched very, very quickly at significant cost. And we would much rather be in a position where we weren't exposed to those names that were coming under pressure and then had to find a way of getting rid of them. We would much rather focus on maintaining high levels of liquidity and very, very high levels of credit control, because ultimately I think that's what our clients are more focused on. Now, of course, what that means is that the published rate of the money market fund would suffer as a result of that if rates continue to slide. But I think we've always taken the view that, or indeed Dick Fisher, who started Federated way back in the 50s, said clients want to get a check. Make sure that clients get a check at the end of every month. And even if the rates did go to 0, I think we'd look to maintain a positive yield, even if it cost the business. We'd still look to do that, even if it was just a published rate of 1. We would probably look to do that for as long as possible, right up until the Bank of England published rate went negative, if indeed it did. And if it did go negative, then that obviously leads to further complications with regard to how money market fund share classes are even structured, because one has to use a whole pile of different share classes.
Yeah, that's an interesting point which is being brought up. I know there's perhaps a couple of different approaches, because under the the reform of the EU money market fund regulations, the previous mechanism of share cancellation in a negative yield environment isn't possible. So perhaps could you just touch on, I believe a lot of managers in the sterling space have told us that they've moved to an accumulating share class model, but I know there's the option of variable pricing as well. Perhaps could you just make a comment on that, what Federated would like you to do and how that works?
Yeah, absolutely. So obviously with an LV NAV distributing share classes you would have normally being priced at 1. If rates go negative, then it's impossible to maintain the actual pricing structure of the fund. So if we move to an accumulating share class, that change in price on a daily basis will be something that is obviously used to mitigate the change in NAV. And so within the prospectus, and indeed within the prospectuses of all the money market funds, they will all have a similar mechanism with which to automatically move clients to a different share class, whereby any change in the NAV is reflected in the price, and that really is the only way it can be done. Obviously, clients have a choice whether they stay in the fund or move elsewhere. The difficulty is of course where you would move to, because one would always like to think that, bearing in mind the whole point of using a money market fund is to get the diversification of using a multitude of different names. The manager itself can obviously take a position across the yield curve that will mitigate to some extent a standalone snapshot interest rate at point in time of X, because with a fund that has a 60-day weighted average maturity, as a short-term fund does, there is an expectation that will be some shape in the yield curve, albeit not a very aggressive one.
Thanks for that. And yeah, I suppose moving on to liquidity and how it's managed. Perhaps just as a reminder, you could briefly touch on how a money market fund manages its liquidity, and perhaps make some comments around the minimum liquidity levels and how you guys are managing that at the moment. Now, you've already said that yield is sort of the secondary consideration to security and liquidity, but how do you sort of tread the line, that balance between trying to keep a yield which is as high as possible, with perhaps some slightly longer dated investments, but maintaining enough liquidity for the flows you're expected to see?
Yeah, that's obviously a very important question. I think that when this whole process started with COVID, because it was so unprecedented, I hate using that word because everybody seems to be using it a lot at the moment, but it's just a situation that no one had seen before, and it's quite difficult to say, well, this is what we would expect to see within the marketplace. And I think if you go back to March, there was certainly quite a lot of interest in the fund and in markets, and there was a lot of flow in and out of money market funds in a very, very immediate, short-term situation at the beginning of March. That said, the vast majority of the flows actually over the coming months have been into the fund, because as people have put various programs on hold, so to speak, or there's been a large inflow into the public sector from central government, everyone's needed to put that money somewhere they've deemed to be safe. And of course, money market funds is a very safe place to put your money, and as a result, lots of money has come into the fund, and indeed other funds, not just ours. But to put it in perspective, we did have one day in a £6 billion fund where we had £1 billion into the fund in a single day, which is very significant. And in fact, it's far more difficult to put that money to work in a low interest rate environment than ever is when we have redemptions of the same size. But I think that, as I said before, trying to find things to buy is very difficult, and the fund managers have to work very, very hard to maintain some semblance of yield. But in terms of liquidity, we have to take the view that liquidity needs are going to be higher than they would be normally. We're not seeing that. We're certainly not seeing that at the moment, but we have to err on the side of caution. And indeed, the weighted average maturity, of our fund is much lower than it has been in previous years. We've been maintaining very, very high levels of both overnight and weekly liquidity far in excess of the limits that are stipulated under the statutory rules. And we're doing that because we would always wish to err on the side of caution. But like I said, that's not being needed at the moment. That's not to say it won't be needed at some stage in the future, but at the moment, we are not seeing any sort of pressure on redemptions from the fund at all. If anything, it's the other way around.
Yeah, I think if we got to a situation where a lot of the liquid assets that the fund was investing in were in negative territory, I mean, is there a temptation to extend that weighted average maturity to invest in those instruments which, for a bit longer, that are going to get you a positive return and keep yields above zero, particularly in a competitive environment where, let's be honest, no sterling money market fund wants to be the first one offering a negative return. Do you think there's going to be that temptation there, or are the way the fund is managed is done strictly?
It's certainly a temptation. I don't want to sound obtuse because, well, I just don't want to sound obtuse, but it's, we have never been in a situation as a business where, a client has ever lost a cent in a short-term money market fund. We've never had to support a fund of any sort. We've never asked for help. We've never expected help. And in fact, we've always put in our prospectus that that we would never do that, even when the rules didn't require us to do so. I think it's important to realize that funds stand or fall on the quality of the assets within it. And it can take 50 years to build a reputation for managing money. It's going to get destroyed very, very quickly if you took a step down the yield curve to generate a little bit of extra return and then slipped on a banana skin. We would expect our clients to abandon us in droves if that was the case. And I can absolutely categorically say there is no temptation from our perspective to do that. It's just not there. We have a very, very strict credit team based in Pittsburgh, and every single one of the people on that credit team has unilateral power of veto, and it's entirely blind. So if one person in that 22-person credit committee says, I don't like that name, even if one person says it, it doesn't get approved for the list. And so that would apply to any extensions or what have you. So we will take a very, very hard line on credit. Credit is always deemed to be the most important group at Federated. We've never sought to be the best performing fund. The fact that we have been such a good performing fund over the years is more to do with the experience and diligence of those fund managers rather than any drive to do it. And in fact, my boss, Chris Donahue in the States, constantly berates us, albeit in a friendly way, for being such a good performer. He said, I'd be much happier if you were middle of the road rather than at the top, because it would seem to your clients that you're doing something wrong. So,
no, I'm sure that's a comfort to hear, and I suppose that highlights one of the benefits of money market funds, the credit work that goes on, and yeah, I mean, in terms of liquidity more generally, as we've touched on today, money market funds, including Federated, are managing that liquidity, trying to tread that line between keeping enough liquid assets as well as maintaining a positive yield, and that's a similar approach that our clients will need to take. Money market funds have perhaps a wider investable universe, and a bit more expertise, perhaps, given that, as you've just said, you have individual credit teams and people looking at these things. But I think there is a similarity there. I mean, would it be your expectation that given what we've just spoken about, that money market funds would remain an attractive liquidity proposition in a negative interest rate world?
I think they would, only in so much as there isn't really an alternative. That is the problem. I think one of the things that we would focus on, and one of the things that we would obviously advise clients is always going to be the case, is that confidence plays a very big role in what's happening in financial markets. And at the moment, we're still in a situation where COVID is causing a lot of concerns, especially with these further restrictions being implemented over the last sort of 24 hours or so, and that's going to make people nervous. I think the balancing side to that is there is no doubt that we are, to some extent, edging towards a position where a vaccine is going to be found and then distributed. And I think as soon as that becomes the case, one will see a fairly significant change because everyone will be able to see the light at the end of the tunnel, so to speak. I think the other thing that one has to look at is that if you look at things like what's happening out in retail world and what's happening on the high street, whilst a lot of sandwich shops and coffee shops are struggling very badly because they're not seeing the footfall, the general wider marketplace, the general wider economy, yes, it's shrunk. There's no doubt it's shrunk, and of course it's going to shrunk because there were lots of outlets that were closed. If you look at inflation, if you look at the inflation forecast, for instance, for December for this year, it's pretty similar to what it was last year before COVID struck. So there's no doubt that there remains some confidence with regard to individuals out there spending their money, and obviously that's driving the economy to some extent. But like I said, confidence is going to be very, very key to how we come out of this. And I think that it would be unlikely. I think it's unlikely that we enter an extended period of published negative rates because I don't really know what's going to drive that, unless, of course, there turns out to be some huge Brexit calamity, which is the big unknown at the moment.
Yes, that's it, and I'm sure we could sort of debate the ins and outs of the potential for negative rates and what might drive that for a long time. But I think, perhaps that's a good point to start wrapping up. I think the message is there being that particularly Federated don't see a central case of money market fund rates being net negative, albeit that may be achieved by fees being waived for the foreseeable future as those...
Yes, I should point out that we would do that unilaterally, and that isn't just a Federated thing. I suspect the vast majority of managers would waive their fees as soon as the rate got down to a situation where we needed to do that. I think from our perspective, in terms of our TER, once you get a gross return of around 8 basis points, fees will be waived, and we're not there yet, not by quite some way.
No, that's it. I mean, there are some money market funds in the market who are having to do that already, depending on how they're managing their liquidity situations at the moment and their individual flows. So we are, and our clients are experiencing near zero rates there. Yeah, I mean, I suppose perhaps one final point to ask is, if we were in a situation where rates remain very low for a very long time and fees are what's being called a temporary fee waiver turns into 1, 2, 3 years of those fees being waived, would you see that changing in terms of that cost not being able to be borne by the manager for a period of that long?
Well, it's difficult it would be difficult for me to comment from a Federated perspective going forward. But what I could say is, obviously, as I mentioned right at the start, when our dollar funds were in the same position where they had a published zero return for certainly well over a year, there was no question of that being maintained. I think the Americans just realised that a zero interest rate, in their govy funds and in their treasury funds, just simply wasn't working for them, and therefore the administration just instructed the Fed to raise interest rates. So they did. How sensible that was remains to be seen, but there was no real rationale for doing that. But just in the same way, I think if you look at the wider UK economy, there was certainly no reason to cut interest rates when we did on or around the time of the Brexit vote. That was an entirely unnecessary thing to do because there was no economic driver left to do that. But I think, to answer your question, I think the Bank of England will be very much led by what's happening in the wider economy. Yes, we've seen a hit to the economy, but there are certainly signs, pretty decent signs actually, that the economy is starting to rebound to some extent. The shape of that curve is oft debated, and no one really knows what the shape of that curve is going to look like. But like I said, focusing on the inflation number is quite a good thing to do, because that'll give everyone a fairly good steer on what's happening in the wider economy.
Well, thanks for that, Gavin. I think we'll probably wrap up there. We're almost at the half-hour point. Hopefully, clients have found that interesting. Obviously, if there are any follow-up questions, do let us know. So I think it just remains for me to give a quick plug to next week's Trading Treasury webcast, which is entitled Longer or Lower. That will be with Royal London Asset Management, and looking at the balance between longer durations to get a slightly higher yield, or accepting lower yields, and that sort of balance between security, liquidity, yield. So obviously, in some ways leading on from the discussion that we've had today. So please register for that one, and also keep an eye on Arlene Close's Twitter and LinkedIn profiles, where further details will be published next week. So that's it for today. Thanks for joining us, and thank you very much, Gavin.
Thank you very much for having me. Take care. Goodbye, everybody. Cheers. Bye.